Yes, we are going to plan the revision session into three frames. First one, discussion of previous year questions. This previous year questions will have same pattern only will continue for your exam, but it may not be the same, but it will help you to cover all the topic because most of you might have been revised the topic. Second one, MTP discussion. MTP discussion. Then finally, we will discuss FM important topic. As we discussed in our last session, we are planning to go with first focus on management accounts, that is costing portion. First focus will be cost and management accounting because that topic is discussed very early. So, is there any other suggestions you can please give? Accordingly, we'll add or we'll change the priority. So, please feel free to tell the same. Yes, my dear friends. So, we will go accordingly the same priority as all of you said. So, we'll keep on doing previous year question. We'll try to do as many questions. We'll try to do as many questions. Then we'll go with what? MTP discussion. Then we'll go for how to approach FM important area. Then finally, the entire session is based on costing importance. So let's start with the first suggested answer previous year. We'll go with question. You can also parallelly get the question paper online, or if you want, I can share you the both also. See, MCQ, I would like to tell you everyone, in the last session also I have told you, MCQ, this ICMA has released MCQ portal for 16 syllabus. For 16 syllabus, this MCQ is enough. Already shared in the group. So, this MCQ is enough for your CFM paper. This is the MCQ. These are all previous year question. These are all previous year question. This MCQ is enough. This MCQ only 2016 previous year MTP RTP consolidation. Only previous year RTP MTP consolidation because for you a objective there is a weightage of 20 mark. For you objective there is a weightage of 25 mark. So I am just sharing the same also. Yes. So for time being we are not discussing MCQ for the same. So we are starting with the costing questions. So hope all of you are ready. See, we will start with one marginal costing question. Marginal costing generally minimum 12 mark will be there. They were asking a tricky question which comes for 4 mark. So please don't go through the answer. We'll discuss directly. Calculate margin of safety from the following information. Sales is given, fixed expense is given, profit is given. How to find out margin of safety? Hope all of you are recall the formula. We know margin of safety. So it's a marathon session where we are keep on doing the problem. You can parallelly copy. It is not just like a regular class where you can copy later. So you have to copy parallelly. Yes. So margin of safety, you all know the formula that profit by PV ratio. So in this question, profit is given, PV ratio is not given. So PV ratio we have to find out. We have discussed different formula, S minus V, but we cannot apply if you don't know the V. So you have to do the second alternative formula. That is F plus P by PV ratio into 100. So what is the F? Dial lakh, 6 lakh. Divide by 30 lakh into 100. If I am not wrong, you will get 50%. So your margin of safety, see 4 mark in your pocket. What is the profit? 6 lakh by 50%. If I am not wrong, answer is 12 lakh. Now we'll go for next question. Next, we'll go for next question. Hope all of you are completed. Yes. Now, if you go further, we'll go with one material cost chapter. So material cost, that is what you call standard costing. You should be able to recall the formula. Then standard costing will be very, very easy. So with all your permission, we are going with what? Standard costing question. In MJ Limited, the standard set of material consumption is what? 100 kg at 2.25 per kg in a cost period. Opening stock was 100 kg at 2.25. Purchases made 500 kg at 2.15. Consumption is 110 kg. As a cost of management accountant, you have to calculate material usage variance, material price variance under three of the condition. When it is at point of purchase, FIFO basis and LIFO basis. So hope all of you are ready. The first point is purchase variance. Not purchase, usage variance. So it's a material variance. Usage means you have to take 1 and 3. What is your 1? Standard quantity into standard price, and 3 actual quantity into standard price. So this is the point for you how to do. So they tell very clear that standard sets was kg at a 2.25. So it's a basic questions. From the basic to advanced, we will discuss all the previous year. Generally, any new syllabus, the exam a little bit easy. So that's why this test paper little easy. So 100 into 2.25, what we will get it, my dear friends? 225. What is the AQ? Consumption. AQ means actual quantity consumed. See, please understand, some question AQ might not be given. You have to find out opening stock plus purchases minus closing stock. Opening stock plus purchases minus closing stock. So what you will get here? 110 kg into standard price. What is your standard price? 2.25. So 110 into 2.25, you get it. So what is the material usage variance? Material usage variance 225 minus 248. We know we have to give adverse. If it is a negative, we have to give adverse. If it is a negative, we have to give adverse. Now going further, we'll go for price variance, where we have to take 3 and 4. 3 means AQ into SP, whereas AQ into AP. Now, AQ into AP we know, which is 248. Now, this only will change. Now, this only will change. My dear friends, this came as a 6-mark previous year question. So, how to proceed? That said, when variance is calculated point of purchase. 3 methods they are asking. When variance is calculated point of purchase. If they said point of purchase, we have to take purchase price. If they tell point of purchase, we have to take the purchase price. What is the purchase price? 2.15. So you have to take 110 into 2.15. So what you will get? So what will be the material price variance? 248 minus 237. You will get what? 11. Is it favorable or adverse? Favorable. So this is only first part. You have to do all the different part. What is the other part? What is the other part? What is the other part, my dear friends? Other part, there is a change. They are telling on FIFO basis. What is it by FIFO? FIFO means your issue based on first in, first out. That means you will first issue from your opening, then you will take from your purchase. So that working note we will make it. How it will be now? First from opening. Opening, how many units we have? 100. What is the price for the same? 2.25. So 225. Now, what is your total AQ? Total AQ is 110. That means 100 only is available at opening. That means 10 you will take from purchase. That is, you will take from purchase 10. What is the purchase price? If you take from purchase, it will be, you have to take from purchase price. So it will be 21.5. So you have to take the total. What you will get? 225 plus 21.5, 247. That is a point. So your variance is what? 248 minus 247. You will get 1. Now finally, we'll go for what? LIFO method. They are telling last method is what? LIFO method. So under LIFO method, last in first out. Last means purchases will taken first. If you take purchases the same way, it will come 237 because your purchase price is what? 215. So your material price variance will be 11 favorable. Hope all of you are clear. Please copy fast. Yes. Now this is typing mistake. Whatever may be the method, price only will change. Is remain same. Shall we proceed for the next question? All of you ready? Now we'll go for next method. Now see, this is very very important. I want to tell you. See, we were discussed overhead variance. Students, what they will do now? Group 1 they studied material chapter, labor chapter. They study that chapter alone. But for your exam, maybe overhead or sales variance will come. So what will happen? It will be trouble. Because you will have definitely one question from standard costing. So you have to ensure that overhead chapter and that is overhead variance and sales variance you are studied well. So this is an example which is asking fixed overhead variance, expenditure and volume variance. That is, you are very lucky, only 3 items are asking. So with all your permission, I am just starting. Okay. So you require 1, 4, 6. What is 1? See, we can check it whether we have to do hourly or we can do hourly. Actual hours, everything is given. So standard hour into standard rate, budgeted hour into standard rate, actual hour into actual rate. So hope all of you remember the same. This is the heading. Since they are asking only 3, this is the we have required. AH into AR is also called what? AH into AR is also called what? Actual fixed hour. AH into AR is also called what? Actual fixed hour. BH into SR also called what? Come on friends, I want all your replies. BH into SR is called budgeted fixed hour. BH into SR is called budgeted fixed hour. So these 2 items you can directly take from the question. Actual fixed hour is 40,800. BFOH, budget fixed hour at 40,000. Now SR we have to find out. SR, I think all of you remember the formula. SR is budgeted fixed hour by budgeted hours. Budgeted fixed hour is 40,000 divided by budgeted hours. Budgeted hours is not given, we have to find out, which is 40,000 watt hour. That is how you got budgeted hour. Your budgeted production is 20,000. For every production you require what? 2 hours. So your budgeted hour will be what? So I have given you the budgeted hour working also. I have given you the budgeted hour working also. So now what will come, my dear friends? Can you tell me the answer? Standard rate you got it. Now you want standard hour. What? How can you find out SH? Can you tell me? SH, standard hours per unit. Your actual is what? Actual unit of production is what? 20,000. Into for every hour you will take what? 2 hours. So what will be the standard hour? Because you know the one line meaning. SH will not be given in any question. SH meaning is what? Standard hours for actual production. SH meaning is what? Standard hours for actual production. This will not be given in the question. We have to find out. So what will be the number, my dear friends? 20,800 into 2, 41,600. So this will be 41,600 into 1. You will get 41,600. Now we can go for one by one. Fixed overhead cost variance, which is 1 minus 5. Fixed overhead cost variance, which is 1 minus 5. 41,600 minus 40,800. 41,600 minus 40,800. You will get 800. This 800 is positive. So we can say favorable. Next. Fixed overhead volume variance, which is 1 minus 4. How can you do, my dear friends? 40,000 minus 40,800. What you will get? 800 adverse. Last but not the least. Once again, it's 1 minus 4. So 1 is 41,600. That is, when we return the numbers very well, it will never make mistake. 41,600 minus 40,000. What you will get? 1,600 favorable. Now last but not the least. Fixed overhead expenditure variance, which is what? 4 minus 5. $800. You can counter check whether your answer is correct or not. See, 1,600 favorable, 800 adverse. The net effect is what? 800 favorable. So you can able to counter check. That will also help you. For exam purpose, you have to present like this. Then only you will get the mark. By only this table, you won't get the. So hope all of you are clear. Please copy fast. Now we will proceed to the next question. So this area is over. Next is budgeting chapter. So flexible budget question is most preferable in budgeting chapter. Flexible budget. After the flexible budget, next more chances is what? Production budget. Next more chances is what? Production budget. So this question is exclusively for what? Flexible budget. So hope all of you are ready. I am going to start. A company is at present working at 19% capacity and producing 13,500 units per annum. It operates a flexible budget control system. The following figures are obtained from the budget. 90% and 100%. Sales is what? 15 lakh and 16 lakh. Fixed expense is given. Semi-fixed expense is given. Variable expense is given. Unit made is given. What is the next line, my dear friends? Labor and material cost per unit are constant. They are not given what is the amount. They are not given what is the amount. They are given just only that it is constant at present. Profit margin is what? 10%. You are required to determine differential cost of producing 1,500 units by increasing the capacity to what? 100%. So what you have to do now? The differential cost is nothing but statement of differential cost is nothing but statement of differential cost is nothing but direct material and labor, one item. Next is what? Fixed expense. Next is semi-fixed. Next is variable expense. If you are able to fill this item, 1,500 units. Answer is all. Differential cost is the cost from one level to another. Differential cost is a cost from one level to another level. So now, my dear friends, this is your data. Now, how to get the data? Very easily. 90% is for 13,500. 100% means another 1,500. So differential means one level to another. Fixed here you have 30,500. Generally, fixed expense will be constant. But if you check this data, 30,500, 30,600. What is the difference? 100. This 100 is your differential cost. That is 3,600,000 minus 3,500,000. What about semi-variable? Same way, 1,500,000 minus 97,500. 1,500,000 minus 97,500. Now what is variable expense? 1,49,500 minus 1,45,000. These are all very easy, my dear friends. The only one item we have to get is material and labor. How to get this? This you have to get reverse way. How the reverse way? That is statement of direct material and labor. What is the sales currently, my dear friends? You take any one data. I will take for 90. Sales is what? 15 lakh. Less profit. What is the profit? Profit is 10%. So if you reduce the profit, you will get what? 1,50,000. You will get your total cost. 13,50,000. Now you have to reduce less other cost. See, you want total cost. You go total cost. You want material and labor cost. If you want material and labor cost, if you reduce all other cost, balance cost is what? Material and labor. Balance cost is what? Material and labor. So what is the other cost, my dear friends? Other cost is nothing but 3,500,000 plus 97,500 plus 1,45,000. This is what other cost. This is for how many units? 30,500 units. So what you will get the item, my dear friends? This is your direct material and direct labor. Now how you will get the data here? 8,07,000. They tell it's constant per unit. So 8,07,000 is for 13,500. What will be for 1,500? That's only the point. So answer is over. So this is called total differential cost. Now we have to make the second part. What would be the export price if it is much lower? Export price will be 97,266.67 by 1,500. Any price above. See, 64.84 is our cost. So export your cost, any price above this price you will charge. See, comments also there is a very good mark. If you see the analysis, your question paper is giving the mark weightage 6 mark. The comment also there is a very good mark. So come on friends, please take your time and copy. Now we'll go for another interesting area, transfer pricing. Transfer pricing is very important because maybe your costing, marginal costing part, budgeting part, these are all little bit you have learned in your group 1. Advanced level only in group 2. But transfer pricing is a new topic for you in your group 2. So my dear friends, in this marathon session, I request all of you to be very clear in transfer pricing sum. You have to practice very well because a transfer pricing sum, if it came, that is a very good mark scoring area. Mostly what type of question we discuss in the class, similar type of question only will come for exam. So by keeping in mind the same, you have to make a good focus on that. So with all your permission, I am starting. Yes. So question number none other than B part. A company has two divisions, manufacturing and assembly. At normal volume, 250 units of component YPI per year. The production costs are given below. Direct material, direct labor, variable overhead, fixed overhead, total is 140. The manufacturing division has been manufacturing and selling 250 units per year to outside buyers for 1 lakh, rupees 136. Outside selling price is what? 136. However, the division can manufacture 350 components per year. So my first question to all of you, is there any idle capacities there or not? Is there any idle capacities there or not? We have discussed this wonderful topic by a chart. You can produce up to what capacity? 350. How many units you are selling to outsiders? 250. Is there any balance capacities there? 1 lakh. This 1 lakh only called what? Idle capacity. The assembly division, so you have 1 lakh idle capacity. The assembly division buying the component from outside supplier at 130. They are buying the component from outside supplier at 130. The assembly division has aforesaid to purchase 90,000 components from YPA from the manufacturing division at a rate of 104 per unit. Should the manager of electrical division accept the offer, will an internal transfer be benefit for the company? See, I want to tell every one of you one interesting point. See, each division manager want to improve their performance. Each division manager want to improve their performance. Their ROI, their okay. So, no one will go such a plan which will reduce their performance. That is the first mantra. Second thing, you have to remember, minimum transfer price, anyone will give what? Can you recall? Minimum transfer price. Yes, minimum transfer price is variable cost. That is, variable cost is the additional cost for production. That is variable cost. If any opportunity cost, if you add. If there is no opportunity cost, in this question, there is a idle capacity. See, my dear friends, 350 is the total. 250 outside you are selling. So you have a idle capacity of what? 1 lakh. The requirement is only 90. Suppose the requirement is 1 lakh 50. Then what will happen? Your excess is 1 lakh only. From external sales, you have to take 50,000 extra. That is a big challenge for you. But here, your requirement is only what? 90. So there is no surplus. That is, there is no pressure. You have a sufficient capacity there. So in such a case, there is no point of opportunity cost. Your minimum transfer price will be what? Variable cost. So what is the variable cost for the division? 40 plus 20 plus 12. What is the price, my dear friends? 70. The price is what? 72. So they were asking whether the manager of electrical division accept the offer. Answer will be what? What is the offer price? 104. Correct or not? What is the variable cost? 72. Accept or not? Decision is accept. See, when you will say no, you have no idle capacity. Here you have companies having what? Companies having ideal capacity of 1 lakh and requirement is what? Requirement is only 90,000. See, when you have no idle capacity, then you will not sell any price below the market price. 136 only will price. Because you have one simple mantra, The point is what? If I sell outside, I will get 136. What is the benefit I will get if I sell to you? So your decision will be what? Next they are asking, will an internal transfer be benefit for the company? Yes. Internal transfer will be benefit for the company. That means we will do in shortcut. What is the excess profit? Excess profit will be. Are you ready? I will do shortcut. Right now, at what price the assembly division is buying from market? Can you tell me? 130. At what price they are buying? 130. How do you get it? Yes, they tell that assembly division has been buying the component from outside supplier at 130. Right now they are buying at what? 130. So if it is an internal transfer, instead of 130, they will buy at what price? 104. They will buy at a 104. Correct? Yes or no? So 104 into how many units? 90,000. So this is for excess profit for. I am doing everything shortcut because of our time constraint. So excess profit for what? Excess profit for which division? Assembly. What is the number, my dear friends? 26 into 90,000. This is it. Correct? Now what is the excess profit for electricity division, that is manufacturing? Manufacturing division. See, manufacturing division is getting 104. Their cost is only what? 72. So into 90,000. Because fixed cost, whether you produce or do not produce, it will be same. It is fixed cost apportioned only. So 104 minus 72 into 90,000. You will get what? So total benefit. You have to add this both. This is for the benefit for the company as a whole. Please copy fast. Now, see theory. See, if you are not comfortable on any problems, if you are not comfortable on any one problem, you can go for the last resort. The last option will be a theory. This theory will be general theory only. Term. What is my differential cost? What is my angle of incidence? What is my learning curve? General theory only. That is from your class discussion you can able to make it. If you want to score better on this theory part, what you can do now, we have around 10 question paper of previous year. You can just note down what all the major theory question came, because it's a short note of any 3. That is 3 into 4. Each question 4 marks. Theory, however you written, you will get 2.5 mark only. So better to go with problem. If you with problem, you never mark, will not miss. And I would like to suggest one more point, my dear friends. If you are going to write theory, better you can give some examples. That means we'll make a better understanding. Okay. So this whole question we have discussed, I think so. The first one question is there. 1 second. Yes. So I'm just discussing this question for time being. We'll just discuss 2A. The anticipated sales of Electrical Corporation Limited is 4 lakh. Unit selling price is what? 20. The per unit direct material is 9, labor is 3, other variable is 3. Company is earning a net profit of 5% and to improve the profitability, the following proposal has been discussed. So current data is given. The present administration setup on the regional basis was felt that centralized will reduce the fixed cost by 12,000. The production manager agreed that it will try to work a cost reduction program which will reduce the cost by ₹1 per unit. Little impact on the quality will negligible to the customer. The sales manager opposed the 2 proposals, suggests that it may be possible to increase the number of units sold by 20%, provided the selling price is reduced by 5%. Alternatively, the sales manager, if selling price is increased by 10%, sales number of unit will be reduced by 5%. As a cost management accountant, evaluate aforesaid proposal. Like this decision making question can also test it. So we will discuss how to approach. Hope all of you are ready. So first you should have a data of clear-cut idea of current position. You should have an idea about clear-cut idea of current position. What is the current selling price? Current selling price is rupees 20 each. How many units you are selling? 4 lakh is the total value. 4 lakh is the total value divided by 20. How many units, my dear friends? Is it 20,000 units? Come on, yaar, take your calculator and tell me. 4 lakh by 20 is it 20,000 units? Now, variable cost. What's the direct material? 9. Direct labor? Other variable cost? Other variable cost is 3. So what is the total variable cost? 15 per unit. Correct? Now you have to find out fixed cost reverse rate. Any question you have to find out the missing data is, this is the clue. See, your sales will be a sum total of variable cost, fixed cost, profit. So what is the sales, my dear friends? 4 lakh less profit. What is the profit? 5%. This is your total cost less variable cost. Your unit, as you said, 20,000. For each unit, 15. This is your fixed cost. Data is clear now? Data is clear now? Now how to proceed, my dear friends? They said that the present administration setup is regional basis. It is felt that centralization will reduce the fixed cost by 12,000. Next, production manager has agreed that this will try to work. He will try to work out 1% cost reduction program, which will reduce the cost by 1. There will be no impact. This cost will reduce by what? Sales manager. This is another proposal. Sales manager says that possible increase in sales unit by what? 20%. Provided the selling price reduced by what? 5%. Alternative, as per sales manager, if the selling price is increased by 10%. So I have given this data. Can you just complete, my dear friends? So let's see how many of you got the answer. This is the data. So we start. Yes. We have 4 proposals. Proposal 1, 2, 3, 4. See, what is for the first proposal? First proposal, fixed expenses reduced by 12,000. Balance everything same. So your sales will be what? 4 lakh. Volume of sales is not changing. So less variable cost. Variable cost will be the same because it is not reducing. 20,000 into 15. Contribution. Less fixed cost. See, right now the fixed cost 80. It is going to reduce by 12,000. So 80 minus 12,000, 68,000. You will get profit of what? How many of you got this answer correct? Very good. What is proposal 2, my dear friends? 1 rupee cost of production. So this will be the same. This will change. 20,000. Instead of 15, it will be what? 14. Fixed cost no change. Hope all of you are clear. Next step. Increase the unit sold by 20%. Selling price reduced by 5%. So unit sold 20%. selling price reduced by 5%. So 20% volume and selling price is reduced by 5%. This is variable cost. Right now 20, your unit is increased by 20% into 50. How interesting. So hope all of you are clear. Last option. Sales manager, if selling price is increased by 10%, sales unit reduced by 5%. Selling price increased by 10%. Sales number will reduce by 5%. So 20,000 into 95% into 50. Tell my dear friends, which option you have low, higher the profit? Option 4. Congrats for those who got the correct answer. The first session is over. Now, based upon these comments, you can tell option 4 is best, which increase the profit by 33,000. The comments also very important.